Hi there. This is Dave Keller here at StockCharts.com. Welcome to the final bar. My guest today is JC O'Hara from MKM Partners in the New York area. We're going to talk about a market overall threatening new all-time highs, pushing to new all-time highs, testing that 4,000 level, still not quite making it, but very, very close. Distribution going into the close, but overall trend still resoundingly positive. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, focusing on the trends, focusing on the momentum, where trends are evolving, what's working, what's not. And I'm struck, earlier today, we did recorded a special event talking about leadership rotation with Grayson Rose and Julius DeKempener, and we were looking at charts, and Grayson had brought some individual stock charts, and it just struck me how many charts just overall look fairly constructive, right? There aren't a ton of charts that look bad. They're out there. They're not a ton of them. A lot of charts that look really good, and then there's a bunch of charts that look pretty good. I used to sketch out on a notepad every week. I've gotten away from it, but I used to sketch out by hand different patterns and write tickers that would line up with it. And if I did that now, I would only have a couple buckets, and most of them are pretty constructive. That tells you something about the overall environment, right? When we talk about warning signs and we talk about bearish divergences, challenges to further upside, again, the opportunity, I think the truth is that there are charts out there that are working. There are charts out there that are evolving. We're going to dig into the industrial sector a little bit later in today's show, and you'll see what I mean. Coming up on the show, today we have JC O'Hara from MKM Partners. Tomorrow we have Matt Tuttle from Tuttle Tactical. And then we're taking a market holiday with everyone on Friday. Next week, I will be out of commission, out of the state, out of cell phone range for a week. I'm super looking forward to it, and I'll be back and hopefully better than ever on April 12th. But this show will be in very good hands. We have Aaron Swenlin, Grayson Rose, Julius DeKempener, Greg Schnell, each taking a day next week to break down the market activity after the closing bell. So make sure you tune into the final bar next week. You'll get a couple different guest perspectives, I think, that are very well informed and well practiced. And I'll see you again on April 12th. Let's get to today's market recap. And as we focus on the market today, I'm struck again by another day of distribution going into the close, and sort of this environment of the market going higher, but red on the screen and distribution into the close. This is where it just continues to give me the sense of all is not perfect out there. There are some challenges. What was different today versus a lot of days we've seen up until now is the NASDAQ was up pretty good. Technology was up pretty good, and much more than most other sectors. It's certainly a rebound higher, a push higher from a sector that has certainly had some trouble on a relative basis, on an absolute basis, pulling back when other sectors have not been as challenged. But on a day like today, signaling it at the very least in the short term today, there are some signs of life there. Again, looked at one point as if the S&P might close above 4,000 for the first time. We did not quite make it there, and again came off to just below 39.75 for the close. Mid caps ended up flat for the day. Small caps a little bit above zero. So large caps led the way higher today. The VIX actually back below 19 after today's close. Looking at some other asset classes very quickly, interest rates continuing to increase with the 10-year yield closing around 175 and the TLT down just over 0.5%. The dollar index essentially flat using the UUP. Commodities back up, and commodities had a rough day of it yesterday. Gold and silver both pushing back to the upside with the GLD up 1.5%. Oil prices, on the other hand, so sort of the energy part of the commodity complex down today, and energy was one of the worst of the 11 S&P sectors. Cryptocurrencies essentially mixed, with Bitcoin down a little bit, about 0.25%, but chopped around the zero level for much of the day. Let's look at a daily chart of the S&P and just focus on what's happened. So again, when the S&P is making new all-time highs, which it did on an intraday basis yet again today, I would caution anyone to be too negative, to be too bearish. And I often find myself getting very negative when I see warning signs, because I have seen negative warning signs result in huge declines over my career, 20, 21 years. So I'm certainly, just the spidey sense goes up, the red flag goes up, and I just look for signals. But what I've also learned from a lot of false signals that you get signals that things are topping out and never materializes, to look for breakdowns, right? To draw lines in the sand and say, all right, well, we're seeing some distribution patterns. As long as we remain above X, this position or this chart is okay. So while I see the S&P moving higher on lower momentum, that's certainly a red flag for me. And again, it doesn't mean we're absolutely going to go lower. It just means, to me, the chances of us pushing materially higher from here are lower than the chances of there being some sort of churning, or at the worst a breakdown of sorts. But to confirm that, you need to see the price actually go down, and that's why I've talked about sort of S&P 3700 as being a really good sort of fair line in the sand. That's now 270 points or so below where we're at. That would be a pretty good move lower from where we're at. But we get an 8 to 10% correction from where we're at. That would take us sort of at 3,700, maybe a bit below it, and that would be the move I would see that would cause me to start thinking much more defensive than we are at this point. I'm seeing plenty of charts that are working, and I think that's the other big thing to think about. I was asked in an interview recently about active versus passive, and I pushed back a little bit on the question, saying I think it's one of the biggest problems is people sort of debate, should I be an active manager or should I be a passive manager of my own retirement, or with the funds I'm selecting or whatever. We had David Auerbach yesterday talking about an active REIT ETF versus a passive REIT ETF like the IYR. And to be honest with you, I don't think it's an either or. I think there are places in a portfolio where it could make sense to be more actively managed, and others where it makes sense to be more passively managed. I think this could be one of those times. This could be one of those years where just being in passive products is probably not the best option, only because there are opportunities. There are charts that are working and there are charts that are not. And if they net out to a market kind of choppy sideways, you're not really getting much when you could if you have the opportunity to lean actively into certain things. So what else happened through the course of today? As I mentioned, technology, number one. Second was consumer discretionary. Third, utilities. We talked about the relative strength in utilities. And I caution you anytime, don't think about what you see with the overall market and then think about sector bets based on a projected direction. Don't think the market's doing well, which means utilities probably are not doing well. Focus on what's actually happening. The relative chart of utilities isn't bad. It's actually improving, and it's outperformed on a day like today. Could be some opportunities there. What underperformed today? Energy at the bottom, financials at the just below there, pretty much the same. And then after that, materials and consumer staples. So plenty of potential opportunities, potential movements in there to think about. We're going to go quickly here to the Mindful Investor live chart list with the time we have remaining. I keep coming back to this chart. This is the main breadth chart that we review every Friday. And it's looking at the cumulative advanced decline lines from a number of different market cap tiers. And I'm struck recently, overall, the long-term chart, if you take a step back and look at the long-term trend, these are very clearly trending from lower left to upper right. And when a chart is going up and to the right, you want to assume that that's going to continue until proven otherwise. And I have not seen any of these breadth lines, even touch their 50-day moving average. I've not seen them break below their previous lows. That is the sign of a bullish tape overall. One thing I am noticing right now, as the S&P once again, making a new closing high in the last week, and this is close only at the top on the S&P index, made a new closing high. You'd got a new closing high in the advanced decline line, or just a new high in that level. You did not get that breakout confirmed from the NYSE breadth, from the mid cap breadth, or from the small cap breadth. That is really nitpicking, looking for something that's not overall very bullish. Just a long-term positive read on these breadth lines. And again, more importantly, I would be looking at the overall trajectory. These charts are all making higher highs and higher lows. That's the sign of a healthy uptrend. One thing that might be really interesting to note as we sort of chop around, you saw technology breaking out just today or moving higher. It's worth noting, actually, to go to the chart of the NASDAQ. We'll come back to the new highs here for a second. If you look at the NASDAQ 100, the NDX, it's worth noting we still haven't gotten above this neckline of the short-term, what you could consider an inverted head and shoulders of sorts. Although, to be honest with you, it's a pretty short time frame, but I get the idea. This resistance level around 13,300 or so is the swing highs from early March and mid-March. We get above there, we get back above the 50-day. This is what Tom Bowley, one of my fellow StockCharts contributors, pointed out as being, a breakout there would signal certainly potential upside for technology and other NASDAQ-oriented names. I'm still seeing this head and shoulders distribution top, which was a head, a top surrounded by two lower tops. And as long as we remain below the right shoulder, the last signal was a breakdown of this head and shoulders pattern, which measures further down from where we're at. It measures down to the 200-day moving average, if not a little bit lower. So I think we're right at that decision point as to whether the NASDAQ breaks out and is able to push above this recent resistance level, or whether we roll back down and test some of the lower end of this range that we've been in for the last month or so. I think that could be a really telling signal for what the next couple months may hold. One of the things I was talking about earlier on our special event on rotation was how high could the market go if that's not confirmed by some of the technology indexes, the technology sector. It's an open question. I think we need to be grappling with as we review all of these charts and their rotations. We need to take a quick break. We'll be back with my guest, JC O'Hara. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we review the markets through the lens of technical analysis, behavioral finance, investor psychology, sentiment, momentum, anything we can do to try to make sense of the markets in uncertain times. As a reminder, we love to hear from you. We'll do other mailbag segments in future episodes. We would love to hear from you so we can answer one of your questions on the air. Get your questions to us one of three ways. First is via email, thefinalbar@stockcharts.com. Number 2, on Twitter @finalbarsctv. Number 3, on our YouTube channel. Just put a comment below the video that you're watching. We'll hope to answer one of your questions in a future mailbag segment. Also, as a reminder, the new StockCharts TV on demand is out. It is really well designed. I'm proud of the team and all the great content that they've been able to produce for you. Go to stockchartstv.com, use your email, set up a free account, and start watching all of our content on demand immediately. We're also on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest joining the show once again. Excuse me, JC O'Hara from MKM Partners in the New York area. JC, it's great to have you back on the show. Thanks for joining us.
Dave, thank you for having me back on the last day of the first quarter. Went fast, didn't it?
That's exactly right. And so, getting to quarter end, it's always, the question of rebalancing and what sort of movements you have as the window dressing process sort of evolves. You're really focusing on technology, which, a big day today for tech. Start us here. We're looking at the XLK and also the TBT, which is a short treasury ETF, I think, right?
That is correct. So looking at the TBT, which is short treasuries, and over Q1, this ETF had one of its best quarterly performance in the history of this ETF, right? So very strong price action if you were short bonds, aka yields moving higher. And what I did was I aligned it with the XLK, the technology ETF, and I made it into a relative line, so relative to the S&P, because I really think it's important to show and to understand the dynamics which was going on between yields and technology. And, the second half of last year, there was some degree of correlation, but that correlation was extremely stretched. And it actually, in my mind, completely broke, right? That correlation turned negative, where anytime you came into the day and you saw yields higher, that just automatically meant that technology would be under extreme selling pressure. Mm-hmm. And, it's quite remarkable that you mentioned earlier today that the S&P, reached an all-time closing high. And that occurred without the largest sector over Q1, right? The technology heading into today was the worst performing sector year to date.
That's right.
So it's very interesting that, the overall market was able to push higher without its biggest constituent sector.
It's absolutely right, and it's a great illustration of the strength or the weakness in bonds of rising yields and what that's done to the technology sector. Chart number 2 is digging into a little more detail and has some breadth indicators below the chart of technology. Talk us through this one.
Sure. So, overall, as we start thinking about Q2, we have started to slowly warm up to technology. Now, I get it, and you flip the calendar from one month to the next, from one quarter to the next. Trends don't automatically change. But what I find interesting about technology is, longer term, technology is still in an uptrend, right? If you ask, anybody random, what do you think of technology? They may say that's probably where you find the bad charts. But truthfully, you have 92% of S&P technology constituents above their 200-day moving average. Right? Isn't that a definition of an uptrend? That is bullish. But from a tactical perspective, I find it constructive that technology over the last 6 weeks was extremely washed out. Right? Mm-hmm. One way you can measure washed out conditions are, shorter term moving averages. If you look at what percentage of the technology constituents were above their 20-day moving average. And we found earlier this month that there were, less than 20%. So we have a situation, an environment where long-term trends remain constructive, but short-term washed out conditions occur. Now, over the last few days, you start to see money inflows heading into technology. The money is looking for, beaten down sectors. Money flow is looking for quote unquote value, not the value growth, but value in terms of pullback or discounted prices from recent highs. So I do think heading into Q2, or at least heading into next month, that technology has a very good opportunity here to experience a real bounce, which could be meaningful for P&Ls.
It's a really interesting thesis there, JC, and I love this illustration. And again, to be clear, right? So 90% of the sector basically has remained above the long-term moving average at the lowest point. It's down to 20% of them that remained above their 20-day moving average. That's all of a sudden bounced back up. So there's been that washout movement that you mentioned. I'd love to ask you, we just have about a minute left, JC. I'd love to think, how do you compare what you're seeing with technology? And I get it, sort of an actionable pullback sort of thesis versus something like, energy or financials, which arguably have also had sort of a decent pullback, right? A lot of energy stocks, ConocoPhillips, Marathon Oil come to mind, Oxy sort of pulling back to a 50-day moving average. How do you compare them? Do you see opportunities across the board there, or is there, one of those general areas where you would lean into more than the other for a particular reason?
Great question. And, when you look ahead to next month, I think the correlation between, cyclical value leading one day, the energy and industrial sort of names, and technology lagging on the day, I think that necessarily doesn't have to always play out. Right. I do think new money entering the market is not going to come out of the cyclical value trade, right? The reflationary trade. You're not robbing Peter to pay Paul. I think new money that's coming into the market is going to focus on areas that have already pulled back. So this might actually help overall breadth, right? If you don't have selling pressure from the leading sectors, but you have buying pressure for the lagging sectors, I think that will help, and that often comes after, some intense rotation, which we've seen over the last 4 or 6 weeks. So I think technology is where I'll be leaning for new investments. But at the same time, I still respect the uptrends in industrials. I still respect the uptrends in the energy complex. For a lot of those charts, they still look healthy to me.
It's a great take, JC. Listen, thanks so much for joining us as always. Hope you stay safe, those around you as well, and we'll talk to you again soon, all right? Thank you, Dave. Good being here. So that's JC O'Hara. JC's the chief technician at MKM Partners in the New York area. And again, I've followed JC and his work for many years. Just a great sense of it. I love his illustration of the actionable pullback in technology. And it's true. One of the biggest challenges, I think, for many of us, given this rotational period, is how much of a pullback is enough, right? And I know for me, when I'm looking at the chart of semiconductors and I see a big bearish divergence, and I see potential for huge downside, and I see breaking down the swing lows, I also start thinking very negatively about the downside potential. There certainly is a scenario which you always have to understand the possibility of the fact that that's enough. That's enough of a washout. The RSI gets down to 40. We rotate higher. We make new highs, and we push on into the second quarter. As always, it's all about having those lines in the sand, managing your risk, managing your reward opportunity, and focusing on the signals that are going to help you be in the right charts at the right times. Great take there by JC O'Hara. Let's continue on to our next segment called Sector Deep Dive. What we love to do with some regularity is break down one particular sector and just dig into a little deeper on the themes and the charts related to that sector. Part of this is intended to be a little more educational if you're not familiar with some of these sectors, to sort of tease out some of the groups and the themes. But it's also hopefully something you can incorporate into your own routine. A lot of times we spend much of our time on sort of the surface level of what's working and what isn't. I think it's really helpful to dig into some of these into more detail. Having said that, today we're going to break down the industrial sector. This came to mind, and again, I mentioned earlier we're recording a special, and I was talking with Grayson Rose about what charts he was starting to find in his own screens, and a lot of the names he noticed in the last week were trucking names, which is one of the groups within industrial. So I thought it might be helpful to break down the industrial sector, just focus on a couple of the groups, talk through what makes sense. And the way we're going to do it is using a couple of functions within StockCharts.com. First off, we're going to use what's called the industry summary tool. If you go to charts and tools in the upper left, you'll see the industry summary page. What I like to do is switch to table view because that makes sense for me. It allows you to resort the groups, the lists very easily. Go down to industrials, which is what we're seeing here. We'll start out just doing it alphabetically, and you'll see it's actually a relatively diverse group, right? While overall, yes, these are companies that are going to do well. Cyclical companies are going to do well when the economy is doing well. There are some very different businesses and industries that are represented here. You have things like what we traditionally would think of as industrials, things like heavy construction, machinery, suppliers, and so forth. It's also all the transportation stocks, so railroads, airlines are all part of industrials as well. You get into other sort of random groups like waste and disposal services. What else? Aerospace and defense are within here, and then delivery services, things like UPS and FedEx. So it's in some ways kind of a mishmash, but the central theme is these are stocks that tend to do well when the economy is in good shape. So when we started talking last year during election season about what themes might work, we talked about infrastructure plays and companies that would benefit from improving the infrastructure of the United States. Industrials, that's the sector that comes to mind as companies that would most likely do well. These are the ones that would help rebuild anything. It's sort of in this group. So how do we make sense of a group like this and break down the different industries? So best thing I would argue is sort them on the Scooter ranking. So as you know, we have about 106, I think, industry groups. You throw them all in a pile, you rank them in order from strongest to weakest trends. And that's this column here. This is separate from the Scooter rankings for large cap stocks or small cap stocks or ETFs. It's sort of its own beast here. And as you sort this list, you're basically sorting it from strongest to weakest trend on average for the stocks that make up each of these groups. And the number one group within industrials at this moment is airlines. The weakest group of all of them is defense, as was at the bottom and sort of in the almost in the lowest quarter of industry groups. However, having said that, I would argue that when a lot of these groups, regardless of the Scooter rankings, I think you're going to find some really interesting charts, and a lot of these, the sector overall has really started to improve. The sector index itself is breaking to new highs, and so overall it's been a pretty decent long-term chart. This is the chart of the XLI, by the way, and this is why we're looking at this sector. While the S&P is sort of floundering as technology is, just trying to hook higher and break above swing highs, industrials has just continued to make new highs pretty much every month going back since last June. Most of those you've seen a higher high through the course of the month, and it shows you the strength. And overall, you can see the relative strength that's been relatively strong, making a new relative high again in the month of March. So here on the industry summary, we're going to start with the airlines group. And let's go here. Now we are looking at the airlines. You can sort these in different things. What I tend to do is sort them on Scooter rankings again, just to find the strongest trends down to the weakest trends. And you can see that there's certainly some differentiation in there, but we can look at something like Alaska Airlines. So what's interesting with some of the airlines, these are names that overall are much earlier in their trend than others. So if you think of the chart of the XLI, going on to new highs, the airlines are, a lot of them, still below previous highs. So Alaska has not made it above its late 2019 high yet. However, look at how the relative strength has been very strong over the last 6 months. Take the second half of 2020 as one period, take 2021 as the next period, or even from October on, and you can see how this index broke higher. This is when airlines really have started to work. You can see how the relative strength has been sloping higher. And again, not all of these look identical, but you can see a number of charts that overall are in pretty decent uptrends, by the way. The strongest ranking name within airlines, by the way, is Mesa Air Group, which is a small cap name. So it's a name that might be a little small than some of you are used to. This is under $1 billion market cap. But again, it's had some gaps higher, and it's been moving higher pretty consistently. Some of these are in established uptrends, which are pretty compelling to look for. And again, as long as these remain in higher highs and higher lows, which with improving relative strength, it's not that bad. Second group I want to look at here is trucking. As I mentioned, when I tried to put my friend Grayson Rose's feet to the fire and ask him what groups he was seeing with some good opportunities, he basically said, I would look at the trucking group because that's where I'm just seeing a lot of trends that are working. This is one that you may be familiar with, JB Hunt. It's about an 18 billion market cap name. And again, what I see is a really decent trend. Higher highs, higher lows, not overbought yet. Relative strength making a new high for the last 8 to 10 months or so, sort of getting back up to where it was there in July. But overall, just a nice consistent uptrend, sort of pounding higher and higher. And overall, again, as I mentioned to people, if I had a portfolio of stocks that kind of looked like that in good uptrends with improving relative strength, I probably wouldn't feel that negative about it. What are the lowest ranked groups here? So just to highlight, it's two of them in particular, and one which we'll have to finish with for time, delivery services. So UPS and FedEx are the two big stocks in here. What I will point out, and what you may notice, the charts aren't that bad. FedEx we're looking at here. FedEx topped out in December and it pulled back, made a new swing low here at the end of January. Things started to look really bad for this group as it was undercutting its previous swing lows. Look at what has happened since then, though. Rotating back higher, relative strength starting to improve again. The last 6 weeks have actually been more constructive than not. Here's UPS, which is not quite breaking out yet to the point that FedEx is, but making sort of a bigger base. And overall, you'd be interested to see if this can regain 175 and break to new swing highs. You've got clearly defined risk, clearly defined support around 155 or so. That's right at the 200-day moving average. You have potential for a breakout above 175. The risk would be down to those previous lows in the 200-day. I'd be very interested to see if a chart like UPS can work. That usually is a good sign for the overall market environment. That's a deep dive in industrials. And again, limited time on a show like this. We don't have a ton of time to go through them, but I hope this helps you make sense of it. And that process of the industry summary, the groups, and then the stocks can be very illuminating. Let's wrap this show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number one is the NASDAQ 100. We mentioned this earlier. Again, you can interpret this chart one of two ways. One that I have been favoring is a head and shoulders topping pattern. We broke down through the neckline there in early March. Until proven otherwise, the trend is lower. I would admit I was wrong. If we break above the right shoulder, which is around 13,250 or so, that happens to be the neckline of what could be a smaller sort of head and shoulders, an inverted head and shoulders type of pattern, at the very least a higher low, and this would make a new high. Either way, I think a break above sort of 13,250, 13,300 would indicate a return to previous highs and speak to some of that strength and technology that JC O'Hara was talking about. Chart number two is the industrial sector. We dug into the industrials a little bit today. Again, there's so much more we could go through. I hope you're able to go through your own process. But sectors that are making new highs with improving relative strength in general, I'm never going to feel that bad about having those types of things in my portfolio. Finally, the trucking group. This is the trucking index that we use as part of our industry group universe. It's sort of mid-range when you look at the overall list of industries, but not a bad chart. And again, in the last month, March has been pretty solid with a break to new price highs, a break to new relative highs. I'm looking at this overbought condition on the trucking index, interested to see if you get a bit of a tactical pullback on some of those stocks that have had really good runs up until now. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the final bar. Special thank you to my guest, JC O'Hara from MKM Partners, giving us some thoughts on the technology sector today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.